Thank you for joining us for this exclusive series of discussions on key factors for business expansion to the U.S., created by Bank Leumi USA together with Leumi Israel and Kלכליסט. This series is focused on best practices for scaling up your business as you expand to the U.S. Supporting tech companies has been a main focus for Leumi USA for many years. We leverage on the strengths of our deep global relationship and our presence in New York, Silicon Valley, and Israel to offer access to financial products and services designated for fast-growing tech companies operating globally. As a local U.S. player, Leumi USA is familiar with the nuances of the tech market and its changing trends. Today, I have the pleasure of hosting Idan Netser. Idan is a partner at Sidley Austin, a top 10 international leading law firm with expertise in transactional M&A, tax, and litigation matters. Idan focuses his practice on international emerging technology companies, venture capital, corporate, and partnership taxation issues, including cross-border international investment, joint ventures, mergers, acquisitions, foreign tax credits, and more. Idan holds a doctorate in international taxation from the University of Michigan and has been practicing law in the U.S. for the past 15 years. Thank you, Idan, for joining me today.
Thank you, Uri. It's great to be here and very happy to do another event with the folks from Leumi Tech. It's really a great pleasure to be here. I appreciate this. Today, we're going to be speaking about a couple of main issues that are relevant for founders and entrepreneurs that are coming from Israel into the US. We're based in Silicon Valley, and I'll provide you a little bit more information about the firm. But obviously, this is true also if you're moving to New York or Miami or any other place in the US. We're going to be touching on the issue of a place of incorporation and how a flip looks like. A flip is an inversion transaction. We'll talk about this in a little bit, and also touch upon a few key transfer pricing considerations. These are really things you should be thinking about, sort of almost like a checklist of any issues that when you're moving into the US, you probably want to talk about this with your counsel, with your bank, with people that know, maybe with your investors. But we're here to help. Everybody's here to help, but we thought it would be really important for you guys to become aware of these things. I'm going to be sharing my screen. We have a short presentation to go through, and then I'll be back to full screen, at the very end for summary notes. So bear with me. Here we go. All right, place of incorporation, flips, and key transfer pricing considerations. A couple of words about myself. I'm a lawyer. I'm an Israeli lawyer, very Israeli. You can hear that by my accent. I've been working here in Silicon Valley since 2008, so it's been quite some time. 20 seconds about a firm. We're a big firm, over 2,000 lawyers. We're pretty well known throughout the country and actually worldwide with offices all over the place. We specialize in everything that has to do with tax, technology, M&A, private equity transactions, of course, a lot of litigations and things like that. Not worth spending a lot of time. This is kind of like of our global reach. As you can see, we're pretty much in every major city around the world. That includes the US, but not only. We don't have offices in Israel. We use local firms. We're pretty firm agnostic. We work with all the big brand names that you're all familiar with. But just thought you would enjoy this map. Anyway, let's get right into this issue. The first question I want to be speaking to you about is the issue of place of incorporation. We get this question a lot from either early stage entrepreneurs that have not yet even formed a company, and they'll come to us and ask, hey, should I form an Israeli company? Should I form a UK company? Should I form a Delaware company? Sometimes the question comes up in the context of post incorporation, shortly after the incorporation, pre-funding, or even after you've raised a little bit of money. And I want to share our view. I mean, we do this a lot. We talk with a lot of people, and we also understand that different people have different views. And as a lawyer, I feel obligated to make a qualifier here. Obviously, this is our view. It's a very Silicon Valley US centric view, but we are speaking from the pains and scars of the industry as a whole, as we see those companies both at the earlier stage through funding, and sometimes most of the times through an M&A or an IPO. A SPAC, everyone has a SPAC these days. If you don't have a SPAC, go get a SPAC. But, M&A, IPO, SPAC, or, combination transactions, acquisitions. So we sort of see those issues play out along the way. So, here's the things I want to talk to you. Our view is very simple. You need to be a Delaware corporation. I mean, there's a lot of benefits in being an Israeli corporation, especially if you're in Israel, and you intend on expanding to markets outside of the US, China, Russia, Europe, maybe. In those circumstances, you probably want to be an Israeli company. But if you're planning on fundraising from venture capitals in the US, and if your market is the US market, which is often the case, at least for the clients we see, it's not always the case. And if you're in the crypto space or gaming, right, then you pretty much want to be a Delaware company. And here's why, right? There are a few reasons, and I put in on the slides about 10 reasons, and let's stick through them quickly. So at least you understand some of the substantive, and there are good pros and cons. There are good arguments as to why you want or you don't want to be, but that's our view. So bear with me for just a second. This is why you don't want to be an Israeli company and you want to be a Delaware company. The first issue, we like to call it the Israeli IP trap. And there are a couple of war stories there, including some information that you can find online from publicly traded companies that have reported those issues. But the story I like to describe is the story of Google and Waze. Google acquiring Waze for 1.1 billion. Very happy with the acquisition. It's a great acquisition, celebration day for Israeli startups and for Israeli IP and for Israeli innovation. And what Google does immediately thereafter is they're transferring the IP out of Israel. Now, why they do it is reasons that are beyond just Israeli taxation. They relate to these multinationals, international tax structures. So I'm sure you've heard of the, double Irish, Dutch sandwich, Cayman structures, Bermuda structures, cost sharing arrangement. Those serial tech buyers, right, have pretty robust international tax structures in place that have nothing to do with Israel. They have everything to do with, maximization of U.S. tax credits, deferral versus not deferral structure, optimization of different buckets of income from outside of Israel. There's nothing to do with Israel. But in order for the structure to work, all the IP need to reside in the cost-sharing country, which could be Ireland or, again, Netherlands or a country like that, Switzerland. So what happens is post-acquisition, the IP goes out of the country. Now, I have never seen the IP actually stays in the country. Maybe I can think of a couple of exceptions, but in most deals, post-acquisition, the IP is being merged with the buyer IP structure. So what happens then? The Israeli Tax Authority, take the position that that's another sale for Israeli tax purposes, and rightfully so, which results in additional tax. So when you bring a company for 1.1 billion and you're trying to move the IP out, guess what? You're being hit with another $250 million of tax. Now, Google just paid it, right? That's fine. They weren't very happy with it, right? But they paid it. But the entire industry learned the lesson. And guess what? Now this issue is being negotiated as part of the purchase price. So not always, but many times we see the more informed buyers will go to the target company and say, look, we're going to be incurring another 23, 24, 25% tax here. Sure, the company has some NOLs that can maybe help, but guess what? Let's split the difference. And you as a company just experience an 11, 12% reduction in your purchase price. So beware of that. Having IP in Israel is an issue, right? The second issue is valuations. Like there's an interesting article that was published in the Israeli media a few months ago by S-Cube, an Israeli valuation firm, that substantiate what we always thought to be the case, which is Israeli companies get lower valuations than their US peers. There's no good reason for that. Absolutely no. But that's just the reality, right? It's easier to value a Delaware company. It's easier from a perception perspective to come up with why and justify, right, a valuation that is more aligned with US and Silicon Valley valuations or US valuations in generally, which means typically a higher valuation to your company. The third point is actually a pretty important point. I'm sure you're familiar with the Israeli, voting proxy, right? And all kinds of practices that have evolved to fix all kinds of issues with the Israeli corporate law. That's fine, right? Everyone's giving a proxy to the CEO. You keep managing those proxies. This is not needed in the US. It's needed in Israel simply because the Israeli corporate law requires unanimous consent for a lot of decisions. In the U.S., most decisions, this corporate level decisions can be made with a simple majority. That means that governance is easier in the U.S. And this is just one example. There are other examples as well. The result is you probably want to be under Delaware law just for corporate governance reasons, managing your investors, managing your shareholders, right? Passing corporate decisions, shareholders decisions, board decisions, easier in the U.S. let's talk about tax a little bit. And tax is kind of like an area where I get excited, and most people fall to sleep. I studied tax at the University of Michigan. I have a tax PhD and an LLM. I wrote a book and many articles about these issues. So this is stuff I actually know what I'm talking about. But tax reporting is an issue, right? US folks need to report holdings in everything that is for a foreign financial asset. That includes stock of a foreign company. So if you're fundraising from a fund that already has foreign ownership or ownership in foreign companies, it's probably not an issue because their LPs are pretty accustomed to include all kinds of foreign financial asset reporting in their tax returns. That's fine. And it's important to note that those reporting considerations, they trickle up all the way to the LPs, and the LPs will have to be, will be on the hook for these reporting obligations. Sometimes the fund will be. But if this is a fund that have not done a foreign investment before or invested in a non-US company, you're up for a bit of a surprise, and so are the partners in this fund, because their accountants and tax preparers are going to tell them that now all of their LP needs to take into account this statement that resulted from their investment in an Israeli company, and they're not going to be happy with it, right? Again, it's a manageable issue, but it is an issue, and it is a perception issue. It relates to a couple of other tax issues. One is all kinds of rules that are applicable to holdings in foreign companies. I put some acronyms here. I mean, these are acronyms you need to know about. CFC is a controlled foreign corporation. PFIC is a passive foreign investment company. GILTI is a global income from low tax intangibles that are held outside of the US. And the newest thing that came from the Biden administration is a potential minimum global tax that would be applicable to US company. What this means really is that, US holders, and US holders can, or all your US shareholders, whether they're investors or employees or everyone else, will have to have a very specific language in the investment documentation to deal with a potential tax issue, which could result by reason of them holding shares in a non-US company. It matters how much they hold, whether they hold more than 10% or less than 10%. Some of these rules are applicable regardless of percentage ownership. Some of those rules are only relevant if the company is profitable. Some are not, right? And the bottom line is you're going to end up with a couple of pages in your investment documentation dealing with these things. You're going to have to do a PFIC and CFC analysis annually. There's a lot of tax compliance that goes with it. And I just thought it would be important to flag this because, again, it's okay. It's, a lot of it is manageable, but it's another layer of complication. Let's talk about number 6, tax incentive, QSBS, qualified small business stock. I think this is, in concept, at least close to the kind of like the angel law or Chok HaAngelim in Hebrew, I think. But the QSBS is a pretty important tax benefit that you need to be aware of. And it really goes to income that results from the sale of a US company. The benefit is essentially for every stock of a small company, and small company is defined as any company with assets on the balance sheet of less than 50 million. So most startup stock would qualify at least at the beginning. So founders, early investors, and employees could benefit from this exemption from tax, which essentially exempts for founders and employees, the first 10 million of their income is exempted completely from US taxation, federal taxation, from state. And investors are actually exempt. Their exemption amount is 10 times the amount they invested. This is an important thing. Let me say this again. It's 10 times the amount they invested. So if a US investor invested $4 million in the company, the first $40 million of gain are completely exempt from federal taxation. That's a big deal. The funds know about this. The funds actually rely on this benefit for their return models to their investors. Well, guess what? You can only get this benefit if the target company, if the stock of the company are those of a US company. So stock in an Israeli company do not qualify. And that's why you see Y Combinator and many other investors requiring a flip as a condition to closing. Essentially, they're saying, we're not going to be holding stock in an Israeli company. We want you to flip before we close the transaction and before you issue us our shares. QSBS is a big benefit. You need to be aware of that. Ticking through a bunch of other issues, equity incentives to employees and key hires is an issue. Imagine yourself trying to explain the Section 102 trustee regime for a non-Israeli person. Now, it might not be relevant. They don't need to be under the regime, but explain to them, why Israeli folks receive their equity at the nominal value, whereas they are subject to 409A, which is the strike price for their option, or even explain to them what does that mean to have an option in an Israeli company. Not always easy to do, and trust me, I'm doing this on a bi-weekly basis. And a lot of the U.S. hires, folks that have nothing to do with Israel, are sometimes not very happy knowing that all of a sudden they, if they exercise their options or if there's an exit, there could be some tax implications and lesser of a benefit, but also potentially having to deal with the ITA. They're not very happy about that. Issues that we see lately come up are issues relating to regulatory data and privacy and all kinds of commercial issues. Having the IP in Israel is not that easy from a compliance standpoint, especially if you're dealing with sensitive information, CFIUS, right? Issues relating to cybersecurity, issues relating to dealing with the U.S. government, right? Issues with dealing with companies that deal with the U.S. government, right? And I've seen this more than once, especially recently, that companies are coming to us and saying, we need to have the code in the U.S. We need to be compliant with privacy laws, and being an Israeli company makes it difficult because it's not entirely clear which privacy laws actually apply or how would they apply. Again, these are solvable issues. We get our privacy group involved, and $100,000 later, we come up with a solution. But it's a complication, and it's an ongoing complication that starts at the level of the commercial agreement and how the recitals and how you identify your company, the group company, and the group's IP in front of your customers. Not an easy thing. Number 9 is kind of like a summary of everything. So at the end of the day, you're taking this company and you're fundraising, assuming you're fundraising in the US. Doesn't have to be the case, but let's assume that for a second. Now you need to be pitching your company to an investor and sort of overcome these difficulties or these disadvantages. And every time I describe this to founders, they tell me, look, there are a lot of great Israeli companies out there. And the answer is absolutely, right? A lot of Israeli companies have done extremely well, but not all of them. And it's not always easy. And you're still adding, a couple of layers of complications when you're, walking up and down, Sand Hill Road with those VCs and trying to explain to the partner there why they, the partner at this US VC, needs to be standing in front of their investment committee and explain to everyone how great of an investment this could be, despite all of those disadvantages and despite of the less favorable tax treatment and the lack of exemption and the complication and having to do Israeli tax and IP diligence and getting another counsel involved. It's okay. People do it, but it's just another layer of complications. Now, there are other reasons, which I stated in number 10 there in the slide you see. They relate to transfer pricing complications, permanent establishment risks, especially if the management ends up moving to the US and all the sales and the sales and conclusion of contracts actually happen in the US. Recently, we've done a survey for another company relating to certain IPO disclosures that are required if your IP is in Israel, and of course, public perception. So there are just a lot of reasons, right? But I wanted to touch a little bit about why not. And I think that's what you hear mostly from local counsel or local accounting firm. You would hear, wait a second, it's much more expensive to be a Delaware company. I don't know if that's true. I think it's probably true that it's more expensive to be a Delaware company. US lawyers, for example, are generally speaking more expensive. But how more expensive, that I don't know. I think it's probably 10, 20, or maybe 30% more expensive, which is substantial, right? But I don't think it's extremely more expensive. And that's something to pay attention to because, again, you kind of need to outweigh, just weigh the benefits, the pros and cons, and decide for yourself. But once you've decided, then you're kind of stuck with it and you kind of want to think about it really hard. One thing to do, which is a piece of advice that I give a lot of founders, is go talk to other founders. Go talk to folks that have done it. Go speak with, second, third, fourth time entrepreneurs, folks that have started as an Israeli company, and go check whether the same when they started a company. Ask your fellow CEOs, right? More than you ask the advisors. Let me go to the next slide. I think there are a few issues I want to touch about the flip. So the flip is an inversion transaction whereby you start as an Israeli company and you flip to become a US company. Essentially, you're putting a Delaware Inc. on top of your Israeli company, and the Israeli becomes a subsidiary. It's a tax-free transaction in the US. It's pretty easy, right? From a US point of view, of course, there's no issues. From an Israeli point of view, and that is an issue, and you should be talking to your Israeli counsel about this. Many of the Israeli firms and some of the accounting firms have like a whole practice around those flips. But my understanding is that there's a green route now, and you can do this pretty quickly. And I've done this pretty quickly. I've done this as quickly as 3 weeks, and as long as 8, 9, 10 weeks. In some complex situations, I've seen it drag for like 3-4 months. It takes time, right? And you need to get a ruling, and someone will have to go to the ITA, and there's a complex trustee mechanism where everyone is putting their shares with a trustee to ensure that proper Israeli tax withholding is done in case of a sale, and that's all okay. Make two things to note there. And I called it at the previous slide, the chicken and the egg issue. The idea of let's start as an Israeli company, and if we need to, we'll flip, is actually a bad idea, because a lot of the investors would say, why don't you first flip and then we'll talk to you. So, again, sometimes they'll talk to you and you get to a point when you can get a term sheet, and the term sheet would say, condition to closing, you flip, right? And then you're rushing to get the ruling from the ITA, and complications arise, and it could potentially delay closing by a few weeks, which is, a stressing thing, and, it does have some risks associated with it. So just be careful with that, right? You're better off, getting into the flip now, right, sooner, and coming up to US investors and say, we already flipped, right? So we're already a US company, or at the very least say we're in the process, right? And save some time. It costs money. It's mostly cost money in Israel to pay for the Israeli lawyers or accountants to take you through the process. From a US perspective, it's a simple incorporation and an exchange agreement. These are easy. We've done those 1,000 times. There's no need to incur a special cost. Pay attention to how you treat, if you already have US investors, pay attention to how you treat them in the flip. They may be exempted from the trustee mechanism. So that's something to pay attention to. You don't want to have to go to them and tell them, look, you're now subject to this trust, this Israeli trust that is going to hold your shares. And from a US point of view, it's a pretty big deal. Quickly about risks, and then I have another slide to cover, and that will be it for today. This is not a riskless transaction, because the flip, I believe, from an Israeli perspective, sort of inks or sort of set in stone at the valuation at the flip date, and could potentially subject you to tax if the company tanks and disappear, or things go south big time. So one of the things to pay attention to is talk to your Israeli counsel about the risks. They have a lot of good scaring tactics to try to sway you out of it, but that's fine. You at the very least should know what's going on. One thing to note is that the flip, you placed a US company on top of your Israeli company. You now have a US parent, a Delaware company. That's great. I mean, you solved a lot of the issues I mentioned before, the tax issues, the governance issues, but your IP is still in Israel, right? The flip transaction have not resulted in a move of the IP from the Israel to the US or anywhere else. That is a problem, and you need to be thinking about this, or at the very least, try to think of a solution. One solution is to stay with Israeli IP, but then again, you're in the Israeli IP trap, and you're subject to all kinds of other transfer pricing complications, etc. Another idea is simply to get the IP out of Israel, and you can do that, and there are 3 ways to do it. One is, if you're early enough, you can just sell the IP, get a valuation from an economist, or maybe 2 valuations if needed, conclude the price and the cost, and transfer the IP. That will result in some tax reporting in Israel, and potentially an audit, and even potentially a battle with the ITA regarding the value of the IP, but you can do that. Another strategy is to what we call die on the vine, which is essentially let the old IP die and develop the new IP in Israel, now, and in the US, apologies. Now, this is not that easy, right? Because you need to make sure that these are separate IPs, different products, different lines of businesses, different technologies. We've done it a couple of times. It is possible, but the facts need to align really nicely in order for this to work, right? And a third strategy is a license, which we can talk about that as well, but also requires evaluation and some comparable work, et cetera, et cetera. That brings me to the last slide that I want to talk about, and that is, you moved, whether you flipped or not, whether you're an Israeli company or not, pay close attention to transfer pricing. And the reason I think this is more important than people tend to think about is because the IRS is pretty bullish about these things. And I do have one company now, is an Israeli founded company. It's a US company, but with a substantial R&D center in Israel, much like a lot of other companies, that is now actually being audited by the IRS. And the exam team started the exam with just looking at standard US issues such as GLT, income from a wholly owned foreign subsidiary, and a few other issues that have nothing to do with this issue. But then the transfer pricing issue came up, and the IRS have asked for the transfer pricing study, and the company gave them like a 14 pages a PowerPoint deck prepared by one of the Israeli accounting firms and said, here you go, this is a transfer pricing study. And the agent looked at this and said, no, that's not a study. It's just not even remotely, not even close to being compliant with the US regulations. And, and that whole thing is now collapsing, and we're going to have to we're having to deal with a very angry IRS examiner that said, you got to be joking, right? This is not what is intended to happen. So what do we need? What does need to happen? You need to have a good intercompany agreements. And, there are templates of that, right? If the relationship between the entities are that of a service provider or that of a distributor, a US distributor that quote unquote distributes the services in theirs, that's fine, right? Those models work. We just need to make sure they're done properly. So get the right agreements in place. Don't kind of wave it and say, oh, this, 2 pages is okay. And the other thing is get a transfer pricing study. So the transfer pricing study is an economic study. It's a valuation study. Law firms don't do that. Accounting firms do, and economists do. And what the study concludes is how much should be company transaction. So in a cost plus arrangement, what's the plus, right? In a distributor model, what is the operating profit margin that the distributor should be operating in? And whether it's cost plus 8 or 10 or 5 or 6, doesn't matter. What matters is the analysis in the study they need to be compliant with the US regulation. And there are very detailed regulations on how to do those studies. You need to have a review of the market. You need to, describe competition. You need to assess comparables. You need to deploy a bunch of methods. It's a pretty robust study, and it costs, $8,000 to $12,000. So the idea, and then you update the study every year for a couple other $1,000. It's expensive, but it's not crazy expensive. What is more expensive is having to deal with it in an exam because you thought you can get away with like a 10, 14 pages PowerPoint presentation that is kind of like a semi-study or a study wannabe. That's not going to fly in the US. So pay attention to this. I think we're running a little bit out of time. So I just wanted to say again, thank you for being here. Thank you, כלכליסט, for arranging this. Thank you, לאומי Tech. It's great to be to partner together on yet again another great event. And I'm looking forward for life going back to normal and us meeting in person and doing great events here in Silicon Valley and in Israel. Thank you, everyone.